This video is aimed at providing viewers with a better understanding of Public Finance Management Act, PFMA. The complete name of the PFMA is the Public Finance Management Act No. 1 of 1999, hereafter referred to as the PFMA. The objective of the PFMA is to ensure transparency among other principles around the finances and related management of the institutions within the public sector that this Act applies to. This aligns to the spirit of the Constitution that also refers to these principles. This brings about uniformity within financial reporting as well as day-to-day controls and processes within the financial function. The Act deals with the national and provincial spheres of government and applies to departments, public entities, and constitutional institutions. A department can be either a national or a provincial department. An example of a national department would be the Department of Basic Education. An example of a provincial department would be each province's respective Department of Health. Public entities are listed in either Schedule 2 or 3 of this Act. Examples of Schedule 2 public entities are Eskom and Transnet. Examples of Schedule 3 public entities are the Unemployment Insurance Fund and the South African Revenue Services. Constitutional institutions are mentioned in Chapter 9 of the Constitution. Examples of such institutions are the South African Human Rights Commission and the Public Protector. A complete list of the public entities and constitutional institutions are available on the National Treasury website. Note that in the event of any inconsistency between this Act and any other legislation, this Act prevails. The key definitions that are relevant to the PFMA can be obtained from Chapter 1 of the PFMA. However, this video will take you through the more frequently used definitions. The definitions are as follows. Accounting Officer. The head of a department must be the accounting officer for the department, and the chief executive officer of a constitutional institution must be the accounting officer for that institution. In other words, the term accounting officer would be relevant in the context of this Act to both national and provincial departments as well as constitutional institutions. The accounting officer is mainly responsible for the implementation of this Act in these types of organizations. Accounting Authority. Every public entity must have an authority which must be accountable for the purposes of this Act. If the public entity has a board or other controlling body, that board or controlling body is the accounting authority for that entity. If the public entity does not have a controlling body, the chief executive officer or the other person in charge of the public entity is the accounting authority for that public entity, unless specific legislation applicable to that public entity designates another person as the accounting authority. Constitutional institution means an institution listed in Schedule 1. One can refer to Schedule 1 of the PFMA or Chapter 9 of the Constitution for a list of these institutions. This was also detailed in an earlier video regarding the Constitution. Department means a national or provincial department or a national or provincial government component. Executive authority, in relation to a national department, means the cabinet member who is accountable to Parliament for that department. In other words, the minister of that department. In relation to a provincial department, means the member of the Executive Council of a province who is accountable to the provincial legislature for that department. In other words, the MEC. In relation to a national public entity, means the cabinet member who is accountable to Parliament for that public entity or in whose portfolio it falls, in other words, the minister. And in relation to a provincial public entity, means the member of the Provincial Executive Council who is accountable to the provincial legislature for that public entity or in whose portfolio it falls. Fruitless and wasteful expenditure means expenditure which was made in vain and would have been avoided had reasonable care been exercised. Simply put, this would refer to expenditure that was wasteful when no value was received for such expenditure, or that the expenditure was unnecessary. Examples of such expenditure are avoidable interest, penalties, or spending on an asset when it was not used. Irregular expenditure means expenditure other than unauthorized expenditure incurred in contravention of or that is not in accordance with a requirement of any applicable legislation, including this Act, or the State Tender Board Act, or any regulations made in terms of that Act, or any provincial legislation providing for procurement procedures in that provincial government. In other words, this relates to expenditure that has been incurred without complying with the legislative requirements around procurement and supply chain management. An example of such expenditure is procuring goods and/or services where 3 quotes are required in terms of a specific legislation, but only 2 quotes were obtained. Unauthorized expenditure refers to over-expenditure or expenditure not in accordance with the purpose of a department. Minister means the Minister of Finance. Please note the difference between executive authority and minister, as these terms are used throughout the Act and refer to different ministers. National public entity means a national government business enterprise or a board, commission, company, corporation, fund, or other entity other than a national government business enterprise, which is established in terms of national legislation, fully or substantially funded either from the National Revenue Fund or by way of a tax, levy, or other money imposed in terms of national legislation and accountable to Parliament. National Treasury means the National Treasury established by Section 5 of this Act. Section 5(1) states that a National Treasury is hereby established consisting of the Minister, who is the head of the Treasury, and the National Department or departments responsible for financial and fiscal matters. As indicated in the definitions, this Act establishes a National Treasury, and this also stems from Section 216 of the Constitution. The functions and powers of the National Treasury are defined. Amongst items indicated in Section 6, the National Treasury must manage the budget preparation process, promote and enforce transparency and effective management in respect of revenue, expenditure, assets and liabilities of departments, public entities, and constitutional institutions, must prescribe uniform Treasury norms and standards, must intervene by taking appropriate steps to address a serious or persistent material breach of this Act by a department, public entity, or constitutional institution. The National Treasury is in charge of the National Revenue Fund and must ensure that all money received by the national government must be paid into the fund. The National Treasury must establish appropriate and effective cash management and banking arrangements for the National Revenue Fund. These include prescribing how to open bank accounts, as well as processes and approvals around these processes, as well as the necessary internal control environment. The National Treasury must ensure that there is, at all times, sufficient money in the National Revenue Fund. The South African Revenue Services must promptly deposit into a revenue fund all taxes, levies, duties, fees, and other monies collected by it for that revenue fund. The National Treasury must promptly transfer all taxes, levies, duties, fees, and other monies collected by the South African Revenue Services for a province and deposited into the National Revenue Fund to that province's Provincial Revenue Fund. Provincial Treasuries and Provincial Revenue Funds. There is a Provincial Treasury for each province, consisting of the MEC for Finance in the province, who is the head of the Provincial Treasury, and the provincial department responsible for financial matters in the province. The functions and powers of a provincial treasury, amongst others, must prepare the provincial budget, exercise control over the implementation of the provincial budget, promote and enforce transparency and effective management in respect of revenue, expenditure, assets and liabilities of provincial departments and provincial public entities. Must enforce this Act and any prescribed national and provincial norms and standards, including any prescribed standards of generally recognized accounting practice and uniform classification systems in provincial departments. There is a provincial revenue fund for each province into which all money received by the provincial government must be paid. The provincial treasury of a province is in charge of that province's provincial revenue fund and must enforce compliance with the provisions of Section 226 of the Constitution. National and provincial budgets. Parliament and each provincial legislature must appropriate money for each financial year for the requirements of the state and the province, respectively. The minister must table the annual budget for a financial year in the National Assembly before the start of the financial year, or, in exceptional circumstances, on a date as soon as possible after the start of that financial year, as the minister may determine. The MEC for Finance in a province must table the provincial annual budget for a financial year in the provincial legislature no later than 2 weeks after the tabling of the national annual budget, but the minister may approve an extension of time for the tabling of a provincial budget. The annual budget must be in accordance with a format as may be prescribed and must at least contain, amongst others, estimates of all revenue expected to be raised during the financial year to which the budget relates, estimates of current expenditure for that financial year per vote and per main division within the vote. As indicated in the definitions discussion, every department and every constitutional institution must have an accounting officer. Chapter 5 of the PFMA deals with the requirements of departments and constitutional institutions. The general responsibilities of accounting officers are as follows. Effective, efficient, and transparent systems of financial and risk management and internal control must be in place. This relates to the overall functioning of the organization and also refers to the transparency, which requires these controls to be known by all and communicated to the organization. A system of internal audit under the control and direction of an audit committee. An appropriate procurement and provisioning system which is fair, equitable, transparent, competitive, and cost-effective. Note that this is an area that emanates from Section 217 of the Constitution. This talks to a very crucial aspect of public sector, which relates to procurement of goods and services. Further legislation as well as regulations expand on this requirement. Since government deals with the service delivery mandate as well as taxpayers' money, it is very important to put in place strict rules regarding the manner in which goods and services are procured either from the private sector or from other organs of state. This is also in place to ensure that practices are fair and competitive to all potential service providers. The accounting officer is responsible for the effective, efficient, economical and transparent use of the resources of the department, trading entity or constitutional institution. This indicates that all assets and property under the control of the department or constitutional institution must be used in a prescribed manner as indicated in this section, as these assets belong to the state. The accounting officer must take effective and appropriate steps to collect all money due to the department, trading entity, or constitutional institution, prevent unauthorized, irregular, and fruitless and wasteful expenditure and losses resulting from criminal conduct. This places a responsibility to ensure that proper systems are in place to ensure that all monies due are recovered. There is also a duty for the accounting officer to put controls and systems in place to prevent the above-mentioned expenditure from occurring. If such expenditure does occur, it is considered to be non-compliance with the PFMA. The accounting officer, on discovery of any unauthorized, irregular, or fruitless and wasteful expenditure, must immediately report in writing particulars of the expenditure to the relevant treasury, and in the case of irregular expenditure involving the procurement of goods or services, also to the relevant tender board. This section highlights the reporting requirements if such expenditure does occur. This is also further detailed in guides and frameworks issued by the National Treasury. The accounting officer must take effective and appropriate disciplinary steps against any official in the service of the department, trading entity, or constitutional institution who contravenes or fails to comply with a provision of this Act, or commits an act which undermines the financial management and internal control system of the department, trading entity, or constitutional institution, or makes or permits an unauthorized expenditure, irregular expenditure, or fruitless and wasteful expenditure. This relates to the disciplinary processes that must occur if such expenditure occurs. It is commonly referred to as consequence management. Section 39 deals with accounting officers' responsibilities relating to budgetary control. Section 40 deals with the accounting officer's reporting responsibilities and include a responsibility to keep full and proper records of the financial affairs of the department, trading entity, or constitutional institution in accordance with any prescribed norms and standards. A responsibility to prepare financial statements for each financial year. A responsibility to submit those financial statements within 2 months after the end of the financial year to the Auditor General for auditing and the relevant treasury. Note that, more often than not, this practically translates to the 31st of May of each year. It is thus the accounting officer's responsibility to ensure that there are controls in place throughout the year to ensure that this deadline is met. Any other adjustments to these financial statements after 2 months from year end until the date of the audit report can only come from the audit process. If this deadline is not met, this will result in a non-compliance paragraph in the audit report. Section 40 subsection 3 places further disclosure requirements in the financial statements, such as particulars of material losses through criminal conduct, any unauthorized, irregular, and fruitless and wasteful expenditure that occurred during the year. Note that there is no materiality requirement for unauthorized, irregular, and fruitless and wasteful expenditure. The Act allows for the assignment of powers and duties by accounting officers and allows for them to delegate in writing any powers entrusted in terms of this Act to an official. This is commonly referred to as the delegation of authority. Similar responsibilities are placed on officials in a department, trading entity, or constitutional institution as is placed on the accounting officer as outlined. This area deals with sections of the PFMA that are applicable to public entities. It is very important to understand that there are various types of public entities which are outlined in the schedules of the PFMA as follows. Schedule 2 public entities, also known as major public entities. Examples of these public entities are Eskom, Denel, Transnet, and SAA. Schedule 3A public entities, known as national public entities such as the UIF and SARS. Schedule 3B public entities, known as national government business enterprises. Examples of Schedule 3B entities are South African Bureau of Standards, SABS, and the Public Investment Corporation, known as the PIC. Schedule 3C public entities, known as provincial public entities, for which there is a listing of such entities for each province. Examples of such entities are the Eastern Cape Liquor Board, as well as other respective provincial liquor boards and the Sharks Board. Schedule 3D public entities, known as provincial government business enterprises. Examples of such public entities are the Free State Development Corporation and the Richards Bay Industrial Development Zone Company. These groupings are important since there are various sections of the PFMA that are applicable to all public entities, irrespective of the schedule that they belong to, and there are certain sections of the PFMA as well as the related Treasury regulations that only apply to certain types of public entities. Every public entity must have an authority which must be accountable for purposes of this Act. This was discussed in detail in the definitions section of this video. The accounting authority for a public entity must exercise the duty of utmost care to ensure reasonable protection of the assets and records of the public entity. Section 51 is a very important section of this chapter that deals with the general responsibilities of accounting authorities and is similar to Section 38, which dealt with the general responsibilities of accounting officers as discussed earlier. Section 52 deals with the annual budget and corporate plan by Schedule 2 public entities and government business enterprises, which are Schedule 3B and 3D public entities. A corporate plan covers a period of 3 years that includes, amongst others, the strategic objectives, initiatives, key performance measures, and indicators for assessing performance, and also includes a risk management plan, fraud prevention plan, as well as financial plan with financial projections. Note that this reaffirms a point discussed at the start of this chapter, where it is important to note the various schedules of public entities, as some parts of this chapter is specific to certain types of public entities only. This section requires the accounting authority of these public entities, in particular, to submit to the accounting officer for a department designated by the executive authority responsible for that public entity and to the relevant treasury at least 1 month or another period agreed with the National Treasury before the start of its financial year, a projection of revenue, expenditure and borrowings for that financial year in the prescribed format, and a corporate plan in the prescribed format, covering the affairs of that public entity or business enterprise for the following 3 financial years. If it has subsidiaries, also the affairs of the subsidiaries. The accounting authority must submit to the executive authority responsible for that public entity at least 6 months before the start of the financial year of the department a budget of estimated revenue and expenditure for that financial year for approval by the executive authority. Section 54 indicates that before a public entity concludes certain transactions, commonly known as significant transactions, the relevant treasury must be informed in writing and the transaction must also be approved by the executive authority. These transactions are as follows: establishment or participation in the establishment of a company, participation in a significant partnership, trust, unincorporated joint venture or similar arrangement, acquisition or disposal of a significant shareholding in a company, acquisition or disposal of a significant asset, commencement or cessation of a significant business activity, a significant change in the nature or extent of its interest in a significant partnership, trust, unincorporated joint venture, or similar arrangement. Section 55 deals with the annual report and financial statements of a public entity, as well as the reporting requirements and timelines, which is very similar to Section 40 that is applicable to departments and constitutional institutions as discussed earlier. Section 56 deals with the accounting authorities having the option of delegating any powers entrusted to the accounting authority to an official in the public entity, similar to Section 44 that was discussed earlier. Section 57 places similar responsibilities on officials within the public entity, as is placed on the accounting authority as outlined in Section 51. This chapter highlights the responsibilities of executive authorities, that is, ministers and MECs, for departments as well as public entities. Executive authorities of departments must perform their statutory functions within the limits of the funds authorized for the relevant vote. The executive authority must table the annual report and financial statements of a department or public entity that it is responsible for to Parliament within 1 month after the department or public entity has received the audit report. Section 77 deals with audit committees and states that audit committees must consist of at least 3 persons and must meet at least twice a year. For departments in particular, 1 member must be outside the public service and the chairperson may not be in the employ of the department. Please view the other episodes in this series to gain a better understanding of how public sector operates. In our next video, we will be discussing an extension of the PFMA, that is Treasury Regulations.